Bond markets are no longer sending warnings, they are issuing demands. US Treasury yields are rising at a speed and scale that directly challenge the Federal Reserve's control over financial conditions. This is happening as debt issuance surges, fiscal deficits widen, and global investors quietly reassess the credibility of US policy stability. Every basis point higher tightens liquidity, raises refinancing costs, and exposes fragilities across housing, equities, and sovereign balance sheets. Yet cutting rates risks reigniting inflation and collapsing confidence in the dollar, while holding rates steady accelerates financial stress. The Fed is caught between market forces it no longer fully commands and policy constraints it cannot escape. What looks like a technical bond move is actually a structural shift in who sets the price of money, and the consequences are already spreading through the global financial system. Rising bond yields are increasingly functioning as a real-time referendum on the credibility of long-term policy governance, rather than as a narrow reflection of near-term growth prospects or transient inflation data. The recent surge in US Treasury yields must be understood as a structural signal emerging from the deepest layers of the global financial system. Bond markets, particularly at the long end of the curve, aggregate expectations about fiscal discipline, institutional coherence, political continuity, and the capacity of policymakers to honor future commitments without resorting to destabilizing interventions. When yields rise sharply and persistently despite stable or even moderating inflation data, the message is not one of economic optimism, but of mounting skepticism about the framework within which economic management operates. At the core of this shift lies the rapid deterioration of fiscal visibility. The United States is operating with structurally elevated deficits that are no longer tied to cyclical downturns or emergency conditions. Instead, deficit spending has become embedded in the baseline trajectory of fiscal policy, driven by entitlement growth, rising interest costs, defense expenditures, and political constraints that limit both revenue increases and spending restraint. As deficits widen, the Treasury is compelled to issue an increasing volume of long-dated debt to finance ongoing operations. This supply expansion is occurring at a time when the absorptive capacity of the market is under strain, fundamentally altering the balance between issuers and buyers. Historically, large-scale Treasury issuance could rely on a predictable constellation of buyers. Domestic institutions, foreign central banks, sovereign wealth funds, and regulatory-driven demand from banks created a stable base of demand that allowed the government to fund itself at relatively low and stable real rates. That equilibrium has eroded. Foreign official participation in Treasury auctions has declined steadily as reserve managers diversify away from dollar assets, manage domestic liquidity needs, or respond to geopolitical risk considerations. Simultaneously, domestic banks face balance sheet constraints driven by higher capital requirements, unrealized losses on existing bond holdings, and regulatory scrutiny that discourages duration risk accumulation. The result is a structurally weaker bid for long-term treasuries precisely when supply pressures are intensifying. In this environment, yields rise not because investors demand compensation for expected growth, but because they require a higher risk premium to hold assets whose future real value is increasingly uncertain. That uncertainty is not limited to inflation expectations. It encompasses doubts about the political feasibility of fiscal consolidation, the sustainability of debt servicing costs in a higher rate world, and the willingness of policymakers to tolerate market discipline rather than intervene. Each auction that clears at higher yields reinforces the perception that the market, rather than the central bank or the fiscal authority, is setting the price of capital. This represents a critical shift in power dynamics within the financial system. The Federal Reserve's traditional toolkit is poorly suited to counter this type of pressure. Monetary policy operates primarily through short-term rates and expectations about the path of those rates. When long-term yields rise because investors are questioning fiscal solvency and institutional credibility, adjustments to the policy rate have limited impact. Lowering short-term rates in such a context risks signaling accommodation of fiscal excess or political pressure, which can further erode confidence and push term premiums even higher. Conversely, maintaining restrictive policy in the face of rising long-term yields compounds tightening across the economy, amplifying stress without addressing the root cause. This asymmetry leaves the central bank constrained and reactive rather than authoritative. As long-term yields decouple from central bank guidance, the transmission mechanism of monetary policy becomes distorted. Mortgage rates rise regardless of forward guidance, suppressing housing activity and eroding household balance sheets. Corporate borrowing costs increase even for firms with strong fundamentals, curtailing investment and hiring decisions. State and local governments face higher financing costs, forcing spending cuts or tax increases that feed back into economic activity. Most critically, federal interest expenses accelerate, widening deficits further and reinforcing the very dynamics that pushed yields higher in the first place. This self-reinforcing loop is characteristic of systems under credibility stress. The signaling effect of rising yields extends beyond domestic conditions. US Treasuries function as the global risk-free benchmark, anchoring pricing across asset classes and jurisdictions. When confidence in the long-term stability of US policy weakens, the effects propagate through global capital markets. International investors reassess currency exposure, sovereign risk premiums rise elsewhere, and cross-border funding costs increase. This does not require an explicit crisis event. The adjustment occurs through incremental repricing, gradually tightening global financial conditions and reducing the margin for error across emerging and developed economies alike. Importantly, the current rise in yields is unfolding against a backdrop of diminished institutional buffers. Quantitative easing programs that once absorbed excess supply have been reversed or halted. Central banks are no longer expanding balance sheets aggressively, removing a key stabilizing force from the market. At the same time, political polarization complicates coordinated fiscal responses, increasing the risk that debt ceiling debates, budget standoffs, or abrupt policy shifts further undermine confidence. Markets are acutely sensitive to these signals, particularly when they affect perceptions of continuity and rule-based governance. The erosion of confidence reflected in rising yields is also temporal in nature. Investors are not merely pricing current conditions, they are extending their assessment decades into the future. Long-term bonds embed judgments about demographic pressures, productivity trends, political incentives, and institutional resilience. When yields rise across the curve, it suggests a collective reassessment of the long-run trajectory of policy coherence. This is why yield movements of this nature tend to be persistent rather than episodic. Once credibility is questioned, restoring it requires sustained evidence of discipline and coordination, not short-term interventions. The danger for policymakers lies in misinterpreting the signal. Treating rising yields as a transient market overreaction or as a technical adjustment risks complacency. Bond markets are often early indicators of structural stress because they respond to constraints rather than narratives. Equity markets can remain buoyant under liquidity support and earnings momentum, but bond markets focus relentlessly on solvency, duration, and real returns. When bonds sell off despite stable growth, it indicates that investors are prioritizing capital preservation over opportunity, a hallmark of late-stage confidence erosion. As this dynamic continues, the margin for policy error narrows considerably. Efforts to cap yields through direct intervention risk distorting price discovery and triggering concerns about fiscal dominance. Allowing yields to rise unchecked risks destabilizing the financial system and accelerating economic slowdown. Between these options lies a diminishing space for credible action, one that depends on restoring confidence in long-term fiscal and institutional stability. Without that foundation, monetary policy becomes increasingly ineffective, and market discipline becomes harsher and less forgiving. In this sense, rising bond yields are not merely a financial variable but a systemic warning. They reflect a collective judgment that the assumptions underpinning long-term policy stability are under strain. Addressing this signal requires more than tactical adjustments. It requires a reestablishment of credible constraints, transparency, and coordination across fiscal and monetary authorities. Until such credibility is restored, bond markets will continue to assert themselves as the ultimate arbiter of confidence, tightening conditions in ways that no single institution can fully control. The Federal Reserve is confronting a policy deadlock that strikes at the core of its institutional mandate and credibility. The tension between controlling inflation and preserving financial stability is no longer theoretical or cyclical. It is immediate, structural, and increasingly visible in market behavior. Unlike past tightening cycles where inflation moderation and financial resilience could be pursued sequentially, the current environment forces a simultaneous trade-off between objectives that now directly undermine each other. This deadlock is not the result of miscalculation or delayed action, but of a macro-financial landscape fundamentally altered by persistent inflation dynamics, unprecedented debt accumulation, and heightened market sensitivity to policy signals. Inflation, while no longer accelerating at peak rates, remains structurally embedded in the system. Price pressures are supported by labor market tightness, deglobalization trends, supply chain realignments, energy transition costs, and fiscal expansion that continues to inject demand into the economy. These forces limit the Federal Reserve's ability to declare victory over inflation without risking a resurgence. Any premature easing, particularly one framed as a response to rising bond yields or market stress, would immediately raise doubts about the Fed's commitment to price stability. Inflation expectations, which remain only partially anchored, could shift upward rapidly if investors interpret rate cuts as a concession to political or financial pressure rather than a data-driven decision. At the same time, maintaining a restrictive policy stance in the face of rising long-term yields compounds financial stress across the system. Unlike previous cycles where short-term rates were the dominant transmission channel, current conditions are defined by an independent surge in long-duration yields. This surge tightens financial conditions regardless of the policy rate, raising funding costs for banks, increasing discount rates for asset valuations, and exposing leverage embedded in non-bank financial institutions. The longer the Federal Reserve holds rates at restrictive levels, the more it amplifies the cumulative tightening effect already imposed by the bond market itself. This creates a nonlinear escalation of risk that is difficult to calibrate or reverse. Banks sit at the center of this tension. Higher yields reduce the market value of existing bond portfolios, eroding capital ratios and constraining lending capacity. While headline liquidity metrics may appear stable, underlying balance sheet fragilities are increasingly sensitive to duration risk. Smaller and mid-sized institutions, which rely more heavily on fixed income holdings and deposit stability, face mounting pressure as funding costs rise and asset values fluctuate. The Federal Reserve is acutely aware that aggressive rate cuts could stabilize these pressures in the short term, but at the cost of validating inflationary risks that would ultimately destabilize the system more severely. Beyond the banking sector, leveraged funds and liability-driven investors are being forced to adjust positions in an environment of rising volatility and declining liquidity. Margin requirements increase as bond prices fall, triggering asset sales that further pressure yields. This dynamic effectively substitutes market-driven tightening for formal monetary tightening. Financial conditions worsen not because of explicit policy moves, but because of endogenous market responses to policy constraints. The Federal Reserve, in this scenario, becomes a spectator to a tightening process it did not initiate but cannot easily halt without undermining its credibility. The central problem is that the tools available to the Federal Reserve are ill-suited to address supply-driven increases in yields. When yields rise due to excessive demand or overheating growth, rate hikes and forward guidance can cool activity and restore balance. When yields rise because of massive debt issuance and waning investor appetite, monetary policy loses traction. Adjusting the policy rate does not reduce the volume of bonds the market must absorb, nor does it restore confidence in fiscal discipline. Yield curve control or renewed asset purchases could theoretically cap yields, but such measures would blur the line between monetary and fiscal policy, inviting accusations of debt monetization and political accommodation. Any intervention in the bond market at this stage carries significant signaling risk. Directly suppressing yields could be interpreted as panic, suggesting that authorities believe the system cannot withstand market pricing of risk. It could also reinforce expectations that the Federal Reserve will ultimately backstop fiscal expansion, weakening long-term inflation credibility. Conversely, refraining from intervention allows yields to rise further, increasing the probability of disorderly market conditions and financial accidents. This is the essence of the policy deadlock. Each option mitigates one risk only by exacerbating another, with no clear path to resolving both simultaneously. Markets have begun to internalize this constraint. Volatility patterns indicate a migration of stress from equities into bonds, a reversal of the post-crisis norm where equity markets absorbed most of the adjustment burden. Bond market volatility. Why is particularly destabilizing because it affects the pricing of virtually all other assets. When the risk-free rate becomes volatile, discount rates fluctuate unpredictably, undermining valuation frameworks and risk management models. This erodes confidence not only in specific assets but in the coherence of the financial system itself. The Federal Reserve's communication strategy is also under strain. Forward guidance, once a powerful tool for shaping expectations, loses effectiveness when markets doubt the feasibility of the implied policy path. Statements emphasizing data dependence are interpreted less as reassurance and more as acknowledgement of uncertainty. Each press conference and policy statement is scrutinized for signs of capitulation or rigidity, with markets reacting sharply to perceived shifts in tone. This sensitivity further constrains policymakers, reducing flexibility and increasing the cost of miscommunication. Internationally, the implications of this deadlock are significant. U.S. monetary policy anchors global financial conditions, and uncertainty about the Federal Reserve's reaction function transmits volatility across borders. Higher U.S. yields attract capital flows, strengthening the dollar and tightening conditions for economies with dollar-denominated debt. Central banks abroad face their own versions of the same dilemma, forced to balance domestic stability against external pressures. The inability of the Federal Reserve to decisively resolve its policy conflict amplifies global financial fragmentation and reduces the scope for coordinated responses. What makes the current situation particularly dangerous is its duration. This is not a short-lived period of adjustment but a prolonged phase in which structural forces dominate cyclical ones. Inflation dynamics, fiscal trajectories, and demographic pressures evolve slowly, limiting the speed at which credibility can be restored. In the interim, markets will continue to test the boundaries of policy tolerance, pushing yields higher until a new equilibrium is established or a breaking point is reached. The Federal Reserve's challenge is not simply to choose between inflation control and financial stability, but to navigate a landscape where the pursuit of one objective increasingly destabilizes the other. As this deadlock persists, the risk is not an immediate collapse but a gradual degradation of policy effectiveness. Each incremental rise in yields, each episode of market stress, and each constrained policy response chips away at confidence in the system's ability to self-correct. Over time, this erosion can harden into a new regime characterized by higher volatility, higher risk premiums, and lower tolerance for policy error. The Federal Reserve remains a powerful institution, but its power is increasingly bounded by structural realities that no longer respond predictably to traditional tools. In this environment, the bond market has become the primary arena where these tensions are resolved, often brutally and without regard for institutional preferences. The migration of volatility into this space reflects a recognition that the core of the financial system is where the true constraints lie. Until the underlying conflict between inflation control and financial stability is credibly addressed, the Federal Reserve will remain trapped in a narrow corridor of options, each fraught with consequences that extend far beyond domestic monetary conditions. The acceleration in US Treasury yields is no longer a domestically contained financial development. It is a global macro-financial event with far-reaching spillovers that are now unfolding across multiple regions and asset classes simultaneously. Because US Treasuries function as the foundational risk-free benchmark for the global financial system, movements in their yields recalibrate the price of capital worldwide. When yields rise rapidly and persistently, they transmit tightening effects far beyond US borders, irrespective of local economic conditions or policy intentions elsewhere. This process operates mechanically through capital flows, exchange rates, debt servicing dynamics, and risk premiums, creating a synchronized tightening of global financial conditions without any formal coordination among policymakers. At the most immediate level, rising Treasury yields alter global capital allocation incentives. Higher returns on U.S. government debt, perceived as the safest and most liquid asset class, draw capital away from higher-risk jurisdictions. Emerging markets are particularly vulnerable to this reallocation. Portfolio investors reassess risk-adjusted returns and increasingly favor U.S. assets, leading to capital outflows from emerging economies even when their domestic fundamentals have not deteriorated. These outflows weaken local currencies, raise domestic borrowing costs, and reduce access to external financing. The adjustment is often swift and nonlinear, as current side appreciation itself amplifies investor caution and accelerates further capital flight. Currency dynamics play a central role in amplifying these spillovers. As capital flows back into dollar assets, the US dollar strengthens against a broad range of currencies. For countries with significant dollar-denominated liabilities, this appreciation directly increases the local currency cost of servicing external debt. Sovereigns, corporates, and financial institutions in emerging markets that relied on dollar funding during years of low global rates now face a materially higher debt burden, even in the absence of new borrowing. This constrains fiscal space, forces budgetary reallocations, and raises default risks at the margin. The pressure is particularly acute for economies with limited foreign exchange reserves or persistent current account deficits. Developed economies are not insulated from these dynamics. Although they typically enjoy deeper capital markets and stronger institutional frameworks, they too are affected by the upward reset in global risk-free rates. As U.S. Treasury yields rise, yields on sovereign bonds in Europe, Asia, and other advanced economies follow, driven by arbitrage relationships and global portfolio benchmarks. Governments that became accustomed to ultra-low borrowing costs during the post-crisis period now face higher interest expenses as debt rolls over. This constrains fiscal policy choices, especially in countries with already elevated debt-to-GDP ratios, and complicates efforts to support growth or manage demographic pressures. The spillover into corporate financing is equally significant. Global companies price debt and equity investments relative to risk-free benchmarks. As those benchmarks rise, hurdle rates increase, reducing the number of projects that meet required return thresholds. Investment decisions are delayed or canceled, particularly in capital-intensive sectors such as infrastructure, energy, and manufacturing. Multinational firms reassess expansion plans, and cross-border investment flows slow. This reduction in global capital formation does not manifest as an immediate shock, but as a gradual deceleration in productive capacity growth that weakens medium-term economic prospects. Trade finance is another critical transmission channel. Much of global trade relies on short-term dollar funding to facilitate transactions, manage inventory cycles, and hedge currency risk. Rising U.S. yields increase the cost of this funding, tightening credit conditions for exporters and importers alike. Smaller firms and those operating in emerging markets are disproportionately affected, as they face higher spreads and reduced access to credit lines. As trade finance becomes more expensive and scarce, global trade volumes soften, reinforcing the slowdown in economic activity and weakening the revenue base needed to service existing debts. Financial institutions operating across borders are forced to adjust balance sheets in response to these pressures. Banks and non-bank financial intermediaries reduce risk exposure, shorten duration, and prioritize liquidity. This defensive posture further reduces the availability of credit, particularly in jurisdictions perceived as higher risk. The retreat of global liquidity is not driven by a single policy decision, but emerges organically from thousands of individual risk management choices, responding to higher yields and increased volatility. Once underway, this process is difficult to reverse, as confidence must be restored across multiple dimensions simultaneously. The repricing of global risk also affects asset valuations in subtle but pervasive ways. Equity markets in emerging and developed economies face downward pressure as higher discount rates reduce the present value of future earnings. Real estate markets, which are highly sensitive to financing costs, experience reduced demand and price corrections. Infrastructure and public-private partnership projects struggle to secure financing on viable terms. These valuation adjustments feed back into household wealth, pension fund solvency, and public finances, creating secondary effects that further dampen economic momentum. Crucially, these global spillovers occur without the benefit of coordinated policy responses. While individual central banks may adjust domestic policy settings, their ability to offset externally driven tightening is limited. Lowering local interest rates risks capital outflows and currency depreciation, while maintaining higher rates exacerbates domestic slowdowns. Fiscal policy responses are constrained by higher borrowing costs and market scrutiny. This leaves many governments navigating an increasingly narrow policy corridor, forced to prioritize financial stability over growth-enhancing initiatives. The perception of U.S. Treasuries as a stabilizing anchor is also being challenged. Traditionally, periods of global stress led to falling Treasury yields as in V. Stores sought safety, providing a countercyclical buffer to the system. The current environment is different. Rising yields during periods of uncertainty suggest that treasuries themselves are becoming a source of volatility rather than a shock absorber. This inversion of historical behavior undermines a core assumption embedded in global risk management and portfolio construction models. When the asset assumed to be risk-free exhibits instability, correlations across markets increase, reducing the effectiveness of diversification. Over time, this dynamic contributes to a gradual erosion of global liquidity rather than an acute crisis. Funding becomes incrementally more expensive, risk appetite steadily declines, and financial buffers are slowly depleted. These changes accumulate, leaving the system more vulnerable to exogenous shocks, whether geopolitical, economic, or environmental. The absence of an immediate rupture can create a false sense of security, but the underlying fragility increases with each incremental tightening of conditions. The geopolitical implications are significant. Countries facing external financing stress may be forced to seek alternative sources of funding, adjust foreign policy priorities, or reduce strategic investments. Economic vulnerability can translate into political instability, particularly in regions where social cohesion is already under strain. At the same time, competition for capital intensifies, reinforcing fragmentation in the global financial system as nations pursue self-insurance strategies, regional arrangements, or capital controls. As U.S. yields continue to reset higher, the cumulative impact of these spillovers becomes more pronounced. The global system is adjusting to a new price of capital that reflects not only monetary policy but also fiscal sustainability concerns, demographic trends, and geopolitical risk. This adjustment is uneven and asymmetric, placing disproportionate strain on the most leveraged and externally dependent economies. The fact that these pressures originate from the world's benchmark asset underscores the depth of the challenge. When the safest asset in the system transmits instability rather than absorbing it, the limitations of existing policy frameworks become clear. Central banks can influence domestic conditions, but they cannot easily counteract global repricing driven by structural forces. Fiscal authorities face constraints imposed by markets that are increasingly intolerant of debt expansion. International coordination mechanisms are slow and politically constrained, ill-equipped to respond to rapidly evolving financial dynamics. The current rise in yields, therefore, represents more than a cyclical tightening phase. It is a stress test of global interconnectedness, revealing how deeply integrated and mutually dependent financial systems have become. Each increase in yields reverberates through currencies, balance sheets, and trade flows, tightening the global web incrementally. The resulting environment is one of heightened sensitivity and reduced resilience, where policy options narrow and the cost of miscalculation rises steadily.